Welcome to The Deep Dive, your shortcut to understanding what's really moving the needle in the business world. Today, we're digging into the recent fiscal 2025 fourth quarter and full year results call from Cintas Corporation.
Yeah, it's more than just the numbers, isn't it? It's a really fascinating look into a company with this incredibly long history of, well, consistent performance. We'll be breaking down the key takeaways from their top brass. Todd Schneider, the CEO, Jim Rosakis, the COO, and Scott Drulla, their CFO.
Exactly. This call gives a pretty comprehensive view of their operational muscle, their strategy, and honestly, some quite clever tactics behind their success. We're going to walk you through the results, unpack what management actually said, and try to connect the dots on what it might mean for the market and for you. So let's kick things off with the headline numbers. Cintas had a very strong finish to fiscal 2025. Looks like another record year overall.
Definitely strong finish. For Q4, total revenue grew 8%, hitting $2.67 billion. And the organic growth that's from their existing operations, not new acquisitions, was actually higher at 9%. Impressive.
Okay, 9% organic and profitability.
Also looking healthy. Gross margin ticked up to 49.7% from 49.2%. Operating income as a slice of revenue, that increased 9.1%. And diluted EPS, earnings per share, rose 9% to $1.09.
Solid quarter. And the full fiscal year 25. You set another record.
Indeed. Revenue hit $10.34 billion for the year. That's up 7.7%, with organic growth again strong at 8%.
Okay.
But what's really striking, I think, are the full-year operating margins. Reached an all-time high of 22.8%. It's a pretty big jump from 21.6% the year before.
Wow, okay.
And diluted EPS for the year grew 16.1% to $4.40. These aren't just flashes in the pan, you know. It underscores their knack for consistent execution. We're talking 54 years out of the last 56 with sales and adjusted EPS growth.
54 out of 56. That kind of long-term consistency is pretty rare, isn't it?
It really is something else.
So how exactly are they doing it? Pulling off these margins, this growth, year after year, especially when the economy feels, well, uncertain. Let's peel back the layers a bit.
Yeah.
What drove these numbers? What are they seeing on the ground?
Right, let's get into the segments. For Q4, organic growth was strong pretty much everywhere. Uniform rental and facility services, their biggest piece, grew 7.2%.
Okay.
First aid and safety, that surged 18.5%, big jump there. And the all other category, that's fire protection, uniform direct sale, that was up 11.1%. So really broad-based strength.
That first aid number really jumps out, but let's look at the core. Uniform rental, it's almost half their revenue. You mentioned they gave a detailed mix.
They did, yeah. It shows the breadth within that segment. Uniform rental itself, it's 48%. Then you've got dust control at 19%, hygiene 16%, shop towels only 3%, linen 10%, and catalog makes up the last 4%.
So pretty diversified, even within the main segment.
Exactly. It suggests healthy demand across lots of different service lines, not just relying on one thing.
Got it. And you mentioned margins improving. Gross margin was a highlight, right?
Right.
What specifically drove that, especially in that core uniform rental segment?
Yeah, uniform rental saw a 40 basis point improvement in gross margin. That's 0.4%. And it wasn't just cutting corners. They credited long-term investments paying off, things like supply chain tweaks, garment sharing programs.
Garment sharing.
Yeah, like optimizing how uniforms are cycled and reused across their network. Plus, auto sortation systems in their plants, and this thing they called their proprietary smart truck solution.
Okay, smart truck again.
That
And
was
first aid margins also jumped.
big time, 140 basis points. That was partly strong revenue growth, but also a better mix, more high margin recurring stuff like AED rentals, eye wash stations, and again, savings from smart truck and better sourcing help too.
Okay, you've mentioned smart truck twice now. Can you maybe elaborate a bit? What is it, and how do these investments directly lead to better efficiency and margins?
Sure. Think of SmartTruck as a really sophisticated logistics platform. It helps their drivers plan routes more efficiently, less driving time, less fuel.
Okay, makes sense.
It's a key part of making their people more productive. Combine that with things like the garment sharing I mentioned, using their SAP system to manage inventory better across the whole network, automating the plants. It's a whole system focused on operational excellence.
Right.
Getting more out of their assets.
Yeah.
It means their route growth, the number of trucks and drivers, grows much slower than their revenue. That's how they scale efficiently.
Very interesting. So they're generating all this growth and efficiency. Where's the cash going?
Yeah.
Let's talk capital allocation. Fiscal 25 sounded pretty busy on that front.
It definitely was. They generated $1.6 billion in free cash flow in FY25. That's a really healthy sign.
Huge number.
In Q4 alone, they put $114.6 million into CapEx. That's investing in buildings, equipment. spent $34.1 million on acquisitions, paid out $157.8 million in dividends, and bought back $256.7 million of their own stock.
Okay, so hitting all the levers in Q4, what about the full year picture?
Full year, CapEx was $48.9 million, holding steady around 4% of revenue. Pretty lean. Acquisitions totaled $232.9 million.
That sounds like a lot for them.
It was their biggest year for M&A in nearly 20 years, if you exclude a huge deal back in 2017. These were mostly bolt-ons, smaller strategic buys across all three route-based segments, adding customers, capacity, getting synergies.
So investing back in the business, expanding via acquisition, but they also returned, what, over $1.5 billion to shareholders?
Yeah, through dividends and buybacks combined, almost $612 million just in dividends. And that marked their 41st consecutive year raising the dividend since going public.
41 years. That's quite a streak. Does that signal they're running out of internal growth ideas, or is it just confidence?
That's a fair question. I think it signals discipline and confidence more than anything. Confidence in their cash flow, commitment to shareholders, but they're clearly still investing heavily in growth too, both organic and M&A. It looks like a balanced approach.
Okay, balance.
Oh.
So looking ahead now, what's the guidance for fiscal 2026? What are they telling the market to expect?
They gave pretty clear guidance. Revenue expected between $11 billion and $11.15 billion. That's total growth of about 6.4% to 7.8%.
Okay. And earnings?
Diluted EPS projected between $4.81 and $4.85. So growth there of 7% to 10.2%.
And what are the big assumptions behind those numbers? Anything we need to keep in mind?
Standard stuff, mostly. Assumes the same number of workdays, no future acquisitions baked in, stable currency rates, about $98 million in net interest expense, and a 20% tax rate, same as last year.
Right, the usual caveats. No big economic shocks assumed either, I guess.
Correct. And no future share buybacks included in that EPS number. So it's kind of a baseline forecast.
And what does that guidance imply for margins, sort of at the midpoint?
Implied operating margin is looking north of 23%. And incrementals, how much profit they make on each new dollar of sales, are expected in the high 20s.
High 20s incrementals, that's pretty strong.
Very healthy, yeah. Shows new sales are quite profitable. Segment-wise, they see rental growing mid to high single digits, fire and first aid continuing double-digit growth, and uniform direct sale, low single digits. They see that last one as more strategic for cross-selling.
Okay, that sets the stage. Which brings us to the broader investor context. How are they seeing the current economy? You know, it still feels a bit choppy out there. What signals should you, the listener, maybe pay attention to?
Well, management said the selling environment hasn't really changed much for them. Customer behavior is stable, new business is strong, retention rates look good.
That sounds positive.
Yeah.
Almost surprisingly so.
It does. They acknowledge the uncertainty, tariffs, trade, interest rates, all that. But they argue their value proposition holds up well across cycles. That 54 out of 56 years of growth kind of backs that up.
Right.
They actually framed the uncertainty as an opportunity. Like, they mentioned saving a customer money on disposable gloves.
Yeah.
Simple stuff, but it builds loyalty when times are tight.
That makes sense. Little wins add up. Now, margins. They hit 22.4% operating profit in Q4. Full year incrementals were 35%, excluding a land sale. Q4 was maybe a bit tougher comparison.
Yeah, Q4 last year was apparently the best profit quarter ever, so tough comp. But they're still in what they call their sweet spot for incrementals, 25% to 35%.
And staying in that sweet spot, even while investing in things like SAP for the fire business. What's the thinking there? Just balancing growth and profit.
Seems like it. They stress they're investing for the future, but also mindful of potential cost pressures. That sweet spot feels like a deliberate strategy, reinvest enough for long-term health, but deliver solid profits now.
Got it. They talked about adds and stops, customer gains and losses. Didn't give hard numbers, but how are they feeling about customer churn versus new ads?
Sounded confident. They pointed to their broad base, 70% services customers, 30% goods producing. That mix gives them resilience if one sector slows down.
And they mentioned focusing on specific verticals, right? Healthcare, government, education, hospitality. What's the play there?
Deeper expertise. By organizing around these segments, they get to know the specific needs intimately, develop tailored solutions. They expect these areas to grow faster than average for them. Yeah, they talked about expanding their scrub dispensing service beyond just hospitals and some patented tech they developed for privacy curtains in healthcare. It shows how deep dives into verticals can spark wider innovations.
Interesting. Okay, back to first aid, that high growth area. You mentioned recurring revenue like AEDs, eye wash stations. Q4 had a training spike, though. Is the double-digit growth outlook sustainable without that spike?
They think low double digits is sustainable, yeah.
Yeah.
The training spike was unusual, but the recurring revenue base from AEDs, first aid cabinets, eye wash, water service, that's the engine driving consistent growth there.
Okay. And conversely, the uniform direct sale business.
Yeah.
Low single-digit growth expected. Q4 was strong, but maybe not representative.
Right. They called FY25 bumpy for that segment. Q4 was a strong close, but it's lumpy, depends on big customer rollouts. So yeah, don't expect that Q4 pace to continue. It's more valuable as a way to get a foot in the door for their route services.
Makes sense. And just broadly, end markets. Any specific areas of weakness they called out across their huge customer base?
Not really. No specific weakness. They did note goods-producing customers have felt some pressure, while service providers are generally busy trying to meet demand. They'd like to see more U.S. production, more certainty on trade, things that might encourage businesses to invest more.
Okay. Now, M&A, guidance says no future acquisitions, but their commentary sounded different. Highly active. Decades of relationships. How do we square that?
Yeah, that's a key point. Guidance is usually conservative on M&A because it's unpredictable. But the commentary, that signals intent. They're constantly looking for good bolt-on deals, businesses with good customers, good employers that add capacity or synergies.
So despite the guidance, M&A is still very much part of the plan.
I'd say so. They sound actively engaged in finding opportunities across all three route businesses. They see a lot of market potential still out there.
Okay. And lastly, technology. They've been investing for years. SAP, data, now AI. How big a deal is AI for them going forward?
They called it early innings. So not expecting a massive immediate shift, but they definitely see potential, making employees more productive, making customer interactions easier.
Like smart truck and garment sharing are current examples.
Exactly. Those are tech-driven efficiencies already happening. AI is likely the next layer, driving incremental improvements over many years rather than some sudden revolution.
And competition.
Yeah.
Pricing. Is it a dogfight out there, or is there room for everyone?
Still competitive, for sure, but Cintas doesn't see it as a finite pie. They point to the huge number of businesses not using any provider, like 16, 17 million in the US and Canada, versus their 1 million customers.
Wow, massive untapped market.
Right, so their focus is winning over those no programmers and selling more value to existing customers. Pricing is apparently back to normal historical levels, not the main growth driver. Growth comes from volume, more customers, more services per customer.
All right, that brings us to our This Is Not Financial Advice segment. Time to pitch an outrageous but plausible trade idea based on this deep dive.
Okay, so given Cintas' strong balance sheet, all that free cash flow, $1.6 billion last year, and their track record of M&A, including that big bolt-on year, how about considering a long-dated, out-of-the-money call option on Cintas?
Okay, long-dated OTM call. What's the outrageous part? Because that sounds somewhat conventional for a solid company.
The outrageous part is that management's explicit guidance for fiscal 26 says no future acquisitions.
Right. So you're betting against their own forecast.
Kind of. The plausible counter-argument is everything else they said. Highly active M&A, decades of relationships, building that war chest because operational excellence maybe frees up cash from traditional CapEx. The trade is essentially a bet that despite the conservative guidance today, they pull the trigger on something bigger than a bolt-on within, say, the next 18 to 24 months. Something transformative that expands service lines or geography significantly.
And the idea is that kind of move would cause a major re-rating, blowing past current expectations.
Exactly. A potential upside surprise for anyone willing to look beyond the immediate guidance and bet on their M&A track record and commentary.
Interesting. An outrageous but plausible idea indeed. All right, that wraps up our deep dive into Cintas Corporation's fiscal 2025 earnings call. We've covered the strong results, the strategic moves driving efficiency, and their outlook.
Yeah, I think the key themes are resilience, that disciplined capital allocation, returning cash while still investing, and the relentless focus on operational efficiency and customer value. Smart truck, M&A, technology, it all feeds into that consistent growth story.
Definitely a lot to unpack there. And remember, this discussion is purely for educational purposes. It should absolutely not be taken as financial advice. Always do your own homework before making any investment decisions.
Absolutely. We hope this deep dive gave you some valuable insights. What stood out most to you? Let us know your thoughts. Until next time, stay informed.